Book name, Money Master the Game. Every financial advisor smiling at you across a desk is legally allowed to not act in your best interest. Let that land for a second. The person managing your money, the one with the certificates on the wall and the confident handshake, is in many cases legally permitted to recommend investments that make them more money, even when better options exist for you. Not rogue criminals, not outliers. Standard industry practice. Legal, documented, happening right now to millions of people who have no idea. Think about the last time money crossed your mind with any anxiety attached to it. Maybe it was this morning. You checked your balance before a purchase and felt that low-grade stress that does not fully go away. Or maybe it was scrolling past someone your age talking about their portfolio, their passive income, their financial freedom, and you felt that uncomfortable mix of inspiration and quiet panic because you have been meaning to figure this stuff out for 2 years and somehow it keeps not happening. You open an article about investing, hit 3 acronyms you do not recognize, and quietly close the tab. Tomorrow, you tell yourself. Next month, when things calm down. You are not alone in that, not even slightly. Studies show that financial anxiety affects nearly 2/3 of Americans, regardless of income level. This is not a poor people problem. This is a knowledge gap problem that the financial industry has spent decades making worse because a confused customer is a profitable customer. Here is the promise I am making you right now. By the end of this video, you are going to understand exactly how the financial game is actually structured, what the insiders know that you were never told, and you are going to walk away with a clear, specific starting path that does not require a finance degree, a large income, or a perfect moment to begin. This is the video I wish had existed when I was trying to figure all of this out alone, and I am genuinely glad you found it. Let me show you the villain in this story first, because once you see it, you cannot unsee it. The financial industry is a $70 trillion machine, and like any machine of that size, it is designed to serve itself first. Here is how that plays out for you specifically. Most investment products sold to everyday people, the mutual funds in your 401k, the actively managed accounts that promise to beat the market, carry fees. Annual fees, management fees, administrative fees. Fees that look small on paper, like 1 or 2%, but that silently consume somewhere between 20 and 40% of your total potential wealth over a lifetime of investing. Tony Robbins, who spent years interviewing the world's greatest investors to write the book we are talking about today, found that the average American loses around $300,000 over their lifetime to fees they did not know they were paying. $300,000, quietly extracted, legally, while the industry tells you it is working in your best interest. The algorithm feeding you content, the ads targeting you with get-rich-quick schemes, the financial media generating anxiety-driven headlines, all of it profits from your confusion and inaction. You were handed a system designed by insiders for insiders, and then asked to navigate it without a map. But here is the good news. The insiders wrote down the map, and one man spent years getting them to explain it in plain English. The ability to build financial security is not a talent. It is not something you are born with. It is a skill set, a set of rules, and anyone who learns the rules can play the game. Think about the first time you cooked something from scratch. You had no idea what you were doing. You probably overcomplicated it, made a mess, and it was mediocre. But you learned the basics, you practiced, and now you do not even think about it. Financial literacy works exactly the same way. The first exposure feels overwhelming. The second time, pieces start clicking. By the time you have genuinely learned the framework, it feels obvious. You just needed someone to walk you through it without the jargon and the hidden agenda. The book is Money Master the Game by Tony Robbins. Robbins spent 4 years interviewing 50 of the world's most elite investors, people like Dalio, Warren Buffett, Bogle Carl Icahn. and distilled everything they shared into a system that any ordinary person can actually use. It is over 600 pages, so I am going to give you the core of what actually matters right now. Let us start with the most important concept in the entire book, the one that changes everything the moment you understand it. Robbins calls it the most important financial decision of your life, and it is not which stock to pick or which fund to choose. It is deciding what percentage of your income becomes untouchable savings before you do anything else with your paycheck. He calls this becoming an investor, not just an earner. Most people earn, spend whatever is left, and try to save the remainder. The problem is, there is almost never a remainder. Life expands to fill available money. Robbins flips the sequence entirely. You decide a percentage first. Even if it starts at 1 or 2%, you automate it so it moves before you touch your paycheck, and you live on the rest. The magic is in the automation. Your brain adjusts to the available income, not the gross income. You feel almost no difference in your daily life. But behind the scenes, a snowball starts forming. The action today is non-negotiable. Open your bank app right now, not tonight, right now, and find the recurring transfer option. Set up even a $10 automatic transfer to a separate savings account timed to your next payday. $10. The amount is irrelevant. The identity shift is everything. You just became someone who pays themselves first. Now here's where Robbins reveals something the financial industry has been quietly hoping you never figure out. There are 2 types of investment fees, and most people only know about one of them. The visible fee is what you see on paper, the expense ratio of a fund, the management percentage. The invisible fee is called transaction costs, and it is the cost of all the buying and selling happening inside actively managed funds that never appears on your statement but absolutely comes out of your returns. Robbins cites research showing that when you add both layers of fees together, actively managed funds cost the average investor somewhere between 2 and 3% annually. That might sound small, but at that drain rate, compounded over 30 years, you lose roughly half your potential wealth. Half. To fees on a product that the data shows almost never outperforms a simple index fund anyway. Research consistently shows that more than 90% of actively managed funds fail to beat their benchmark index over a 10-year period. So you are paying more for worse performance every year you stay in the wrong vehicle. The move Robbins recommends, and it is the same move backed by Buffett, Bogle, and virtually every evidence-based financial researcher alive, low-cost index funds. Specifically, look for funds with expense ratios below 0.2%. Vanguard, Fidelity, and Schwab all offer them. Today's action. If you currently have any investment accounts, look up the expense ratio of every fund in them. Google the fund name plus the words expense ratio. If any of them are above 0.5%, you have found money that is being quietly taken from you, and now you know. Let us go deeper, because the next thing Robbins covers is the concept that transformed how I personally think about risk, and I want you to have it too. He introduces an idea he learned from Ray Dalio, arguably one of the most successful investors in history, called asset allocation. And the core insight is this: it is not which assets you pick that determines your long-term outcome. It is how you divide your money across different types of assets. The reason this matters is that different asset classes, stocks, bonds, real estate, commodities, cash, do not all move in the same direction at the same time. When stocks crash, bonds often rise. When inflation spikes, certain assets thrive while others suffer. Dalio spent decades developing what he calls the all-weather portfolio, a specific allocation designed to perform across every economic environment, not just bull markets. Robbins shares it in the book, and the historical performance data is genuinely remarkable. Back-tested across 30 years, this portfolio lost money in only 4 of those years, and the average loss in those down years was minimal compared to pure stock market crashes. You do not need to copy it exactly. What matters today is this. Look at wherever your savings currently sit. Savings account, single fund, mattress, whatever. And ask yourself whether it is actually diversified or whether you have everything riding on one type of asset. That awareness is step one. Here is something that almost nobody talks about when they discuss investing, and Robbins devotes serious attention to it because it is one of the most powerful forces in personal finance. It is the difference between tax-advantaged accounts and regular taxable accounts, and the gap between them is enormous over time. A Roth IRA is the clearest example. You contribute money you have already paid taxes on, it grows completely tax-free inside the account, and when you withdraw it in retirement, you owe zero taxes on any of the gains. Zero. Compare that to a regular brokerage account, where you pay capital gains tax on every profit every year. On a 30-year growth trajectory, the difference in final balance between a Roth IRA and a taxable account with identical investments can be hundreds of thousands of dollars, not because of better investments, but because of the tax structure alone. Robbins is emphatic about this. Before you put a single dollar into a regular investment account, max out your tax-advantaged options first. For 2024, you can contribute up to $7,000 a year to a Roth IRA if you qualify based on income. Today's action. Go to the IRS website or just Google Roth IRA Income Limits 2024 and check if you qualify. If you do, and you do not have one yet, open one today. Fidelity and Vanguard both let you open one online in about 15 minutes with no minimum balance. Now I want to talk about something Robbins covers that is more psychological than financial, because the numbers only matter if your head is in the right place to use them. He dedicates a significant section to what he calls asymmetric risk and reward, which he learned from traders who consistently win over long periods. The concept is about only taking bets where the potential upside dramatically outweighs the potential downside. The example he gives is simple. If someone offers you a bet where you risk $1 to potentially win 5, that is an asymmetric opportunity. Even if you only win a third of the time, you come out ahead. Most people make the opposite mistake in their financial lives. They take symmetric or even negatively asymmetric risks. They risk a lot to potentially gain a little because the option feels safer or more familiar. Keeping everything in a savings account, earning almost nothing while inflation eats at it, is actually a negatively asymmetric bet. You are guaranteed to slowly lose purchasing power. The risk of doing nothing is often higher than the risk of getting started with a diversified, low-cost portfolio. The action today: write down one financial decision you have been avoiding out of fear and ask yourself honestly, what is the actual worst-case scenario? And what is the potential best-case scenario if I get educated and take the right action? Name both numbers. Make the asymmetry visible. The last major principle Robbins unpacks is the concept he calls the dream bucket, the security bucket, and the risk bucket, and it is a framework for thinking about your money in 3 separate pools with 3 separate purposes and 3 separate rules. Your security bucket is the foundation, safe, boring, low-risk assets that you will not lose sleep over. This is your emergency fund, your Roth IRA contributions, your bond allocations. Your risk or growth bucket is where you take calculated, educated bets for higher returns, stock index funds, real estate, growth investments with longer time horizons. And your dream bucket is a small portion of your money specifically allocated for experiences, joys, and things that make your actual life feel worth living right now, not at 65. Robbins is clear that all 3 buckets matter. Neglecting the dream bucket turns financial responsibility into a joyless prison. Neglecting the security bucket turns the risk bucket into gambling. The framework gives you permission to live fully and build wealth simultaneously, and that balance is what makes the system sustainable. Today's action: On a piece of paper or in your notes app, write the 3 bucket names and put a dollar amount or percentage next to each based on where you want your next paycheck to be distributed. Even rough numbers. The act of categorizing creates clarity. Now let me tell you about someone whose story stopped me mid-chapter when I read this book. Theodore Johnson worked for UPS his entire career. He never earned more than $14,000 a year in his peak earning years. He never received an inheritance. He never won anything. He was, by every conventional measure, an ordinary working American who would have been completely invisible in a financial conversation. But Theodore had one practice that he never deviated from. Every single paycheck, he put 20% into UPS stock, automatically, before he ever saw the money. He did not time the market. He did not make complex trades. He did not have a financial advisor building sophisticated strategies for him. He just automated a percentage and never touched it. By the time Theodore Johnson died, he had accumulated over $70 million. $70 million on a $14,000 salary. The power was not his income. The power was not his intelligence. The power was the consistency of the system running without interruption for decades while compound interest did what compound interest does when you leave it alone long enough. If Theodore Johnson could build $70 million on $14,000 a year, then the question is not whether you have enough money to start. The question is whether you are going to start. And the honest truth is that the only difference between your current situation and the beginning of that story is one decision made today. So here is your challenge. Right now. Not after dinner. Not this weekend. Right now, before you close this video or pick up your phone for something else, I want you to do one thing. Open whatever banking or financial app you have access to and take one of these 3 actions depending on where you are. Set up a $10 automatic transfer to a savings account, or look up the expense ratios in your current investment accounts, or Google how to open a Roth IRA and read the first page. Just one. Choose the one that matches where you actually are right now, because doing one real thing today beats having the perfect plan that you start next month. Starting matters infinitely more than starting perfectly. And when you complete it, you will feel something specific, a small but genuine sense of control. Like you stopped watching the game from the stands and stepped onto the field. That feeling is the beginning of everything. Now picture yourself 2 years from now. You have 2 years of automatic contributions running quietly in the background. You know what is in your accounts. You know what your fees are. You have a security bucket that lets you sleep at night and a growth bucket that is compounding on your behalf every single day, whether you are working, resting, or outliving your life. In your career, you negotiate differently because you are not negotiating from desperation. You have a cushion. You have options. You carry yourself differently because financially fragile people and financially grounded people move through the world differently, and everyone around them can feel it. In your relationships, money arguments are quieter because you have a plan instead of an anxiety spiral. You show up more fully present because the low background hum of financial panic that used to follow you everywhere has finally gone quiet. And inside, you feel something that is genuinely hard to describe to someone who has not felt it yet. The quiet confidence of someone who is playing the long game and actually understands the rules. That is not a fantasy. That is a math problem with a known answer. And you now have most of the variables. Here is what I need you to hear before you go. The reason this felt impossible before is not because you are not smart enough. It is not because you do not make enough money. It is not because you waited too long or started too late. It is because the people who built the financial system benefit from your confusion, and you have been navigating it without the information you needed. Now you have the information. The capability was always inside you. The discipline, the intelligence, the drive to figure things out, you have proven all of that in 100 different areas of your life already. This is just one more system to learn. And you already took the first step by being here, by watching until the end, by caring enough about your own future to show up for it today. If this landed for you, share this video with one person in your life who needs to hear it. Not because we need the numbers, because they deserve the map too. Like this video so more people find it, and subscribe to Book Brief Hub because every single video we make goes this deep. We do not do surface level here. You already have what it takes. The game just got easier.